Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. Today, we are strapping in for a truly essential deep dive. We've really tailored this for you, the beginner U.S. investor, to try and get a crystal clear look at what is, let's be honest, a very confusing market landscape right now.
It really is.
We're going to be pulling together all the latest economic data, looking at the direct impact of current U.S. trade and industrial policies. And I think most critically, we're going to extract the psychological advice you need to maintain discipline in what we're calling an incredibly polarized K-shaped economy. So our analysis has really pulled out four critical themes that are, they're fundamentally reshaping how you should be thinking about your portfolio. First, we'll expose the surprisingly persistent failure of the manufacturing renaissance and what those negative data points truly reveal about the health of the real economy.
The part of the economy that makes actual stuff.
Exactly. Second, we'll pivot to strategy, how to construct a defensive yet still aggressive K-shaped portfolio that's really designed to profit from this polarization.
Right.
Third, we are doing a rigorous health check on the 7 major historical bubble warning signs. And the data is pretty undeniable. 4 of them are flashing bright red right now.
Yeah, that's the alarming part.
And finally, we'll provide essential behavioral and tactical advice for long-term investors, especially for those of you who've been sitting, anxiously on a lot of cash, waiting for a market correction that might not be coming on your timeline.
Well, our mission today is really synthesis. We're taking all this complex, sometimes contradictory source material. Everything from manufacturing indices to the secretive moves we see in investor filings, those 13F forms, and we're going to distill it into actionable, contextualized knowledge. You shouldn't just know that the market is high. You need to understand why it's high, who is benefiting, and maybe most importantly, when the underlying logic that's driving all this momentum might just break. We want to equip you not just with knowledge, but with conviction, so you can make clear decisions regardless of all the daily noise.
Okay, let's unpack this central paradox of the current U.S. economy. On one hand, you hear this relentless political optimism about reshoring, bringing manufacturing jobs back, building new American factories, securing our supply chains.
It's a very popular narrative.
It is. But when we shift our focus from the rhetoric to the hard, cold numbers, the story of the real economy seems, much grimmer. It feels like it's facing a persistent, chilly winter.
That is the core conflict we have to resolve. And the data points from just early this November are they're unequivocal. According to a comprehensive report that came out on November 7th, the manufacturing sector actually saw a loss of 23,000 jobs in October.
Okay, so 23,000 jobs, that's a big number, but what's the context?
Well, the context is what's fascinating and, frankly, deeply problematic. This marks the 5th consecutive month of job reductions in manufacturing.
5 straight months, so this isn't a blip.
Not at all. That's the longest streak of job losses in manufacturing since the severe disruption we saw back in the pandemic era.
So for a beginner investor listening, why is this trend, this sustained job decline, so important when we're talking about the health of the market?
It really highlights that policy paradox you mentioned. Despite massive government incentives, subsidies, strategic attempts to boost domestic production, the whole reshoring effort, those efforts are clearly failing to translate into sustained long-term jobs.
So the headwinds are just stronger than the tailwinds.
That's a perfect way to put it. The headwinds facing manufacturers are just overwhelming the tailwinds from government intervention. And if you look at where the jobs are growing, it's almost entirely in the virtual economy, professional services, AI, information tech. The bedrock blue-collar sector is actually contracting.
And to put a number on that contraction, we can look at the ISM Manufacturing Purchasing Managers Index, or the PMI. It's a crucial barometer of the sector's health, and it came in at 46.7 for October.
And here's the real concern. This is the 9th straight month the PMI has been below that critical 50 threshold.
Let's just spend a moment on that 50 mark, because it's one of the most important numbers for our listeners to track. Think of it like the freezing point for water. Above 50, things are expanding and growing.
Right. Business leaders are reporting growth in new orders, production, hiring. It's a good sign.
But below 50, everything's contracting. It's like the car is stuck in neutral or even reversing.
Exactly. And 9 straight months below 50 isn't just a temporary dip. It signals an entrenched contraction. When we look inside that 46.7 score, we see new orders are weak, inventories are building up.
Meaning they can't sell what they're making.
They can't sell it fast enough. And production is slowing down to compensate. This combination suggests that any kind of short-term rebound in manufacturing is not only unlikely, but that this contraction is probably baked into the system for the next, 2 or 3 quarters.
The market often tries to ignore these real economy signals if big tech is doing well, but this kind of persistent weakness in manufacturing employment, that's a fundamental crack in the foundation the market can't ignore forever.
And the primary reason for this paralysis, according to our analysis, is the severe regulatory uncertainty created by trade policy. The current administration provides these huge financial incentives, billions in subsidies, to build factories here.
The carrots.
The carrots. But the threat of ongoing, unpredictable tariffs acts as a profound restraint on investment capital. It's the whip.
We've certainly seen trade disputes create an extreme roller coaster effect recently. I remember the talk in October about potential 100% tariffs on some imports, and then a week later, it's news of a one-year truce with China. That kind of volatility has to be crippling for business planning.
It's actually more damaging than the tariff cost itself. It's the unpredictability. I mean, imagine you're the CEO. You're looking to commit, say, $5 billion to build a new assembly plant.
A huge multi-year project.
Right. It takes 3 to 5 years just to get it fully operational. And that plant relies on a complex global supply chain for raw materials, machinery, all sorts of components. If trade policy means the cost of your essential inputs could double or even disappear overnight based on a single political decision.
You can't commit. You just can't rationally commit that capital.
So instead of building and hiring, you just wait.
You wait for stability. You freeze your long-term capital spending.
Precisely. That prolonged wait-and-see posture is the defining feature of this real economy recession. Capital is just refusing to deploy because the regulatory ground keeps shifting underneath it.
And we see that in company reports, right?
We do. Take the recent Magna case study. Magna is a major auto supplier, and they announced they had successfully reduced the financial impact of tariffs from a projected $200 million down to about $30 million.
Wow. So on paper, that sounds like a huge win, $170 million savings.
But here's the critical analytical nuance. That $170 million reduction didn't just materialize out of thin air. It required massive, non-productive administrative costs.
Ah, okay, the hidden cost.
The hidden cost. They had to divert huge internal resources, legal teams, sourcing specialists, compliance officers, just to restructure their supply chains, fill out endless paperwork, and prove origin to qualify for these avoidance schemes.
So in reality, they didn't really save the $170 million. They just spent it on administrative overhead and compliance schemes instead of on, say, innovation.
Correct. That's money that should have been used for R&D, for productivity improvements, for long-term investments that create high-quality jobs. Instead, it was just wasted on tariff avoidance. This systemic waste of corporate efficiency means U.S. manufacturers are inherently less competitive than their rivals who are operating in more stable trade environments. This regulatory burden is basically a tax on growth, and it helps explain why job creation is flatlining, even with all the incentives.
Okay, so we have this stagnation and job loss paralyzing the traditional tangible economy, but the overall stock market has been celebrating, hitting new highs. This disconnect is what we're defining as the K-shaped economy.
The K-shape is the essential visual for understanding the U.S. economic reality today. It's basically splitting the U.S. economy into two divergent paths, and they're moving away from each other, not in tandem.
So let's define those paths clearly. We've got the upward slope of the virtual economy.
The rising K is being driven by structural, exponential growth. This is big tech, AI infrastructure, cloud computing, and a handful of companies that are benefiting astronomically from the AI revolution. They are, for the most part, insulated from high interest rates because they're sitting on mountains of cash.
Right, their balance sheets are rock solid.
And they're insulated from tariff risks because their primary inputs are often intellectual property and computing power, not, physical components from overseas.
And then there's the downward slope, the stagnant, real economy.
The falling K. That's manufacturing, heavy industry, Main Street retail, and sectors that really depend on cyclical consumption and stable trade. They're dealing with that difficult triple threat we talked about. High interest rates making new investment prohibitively expensive, the burden of unpredictable tariffs eroding their efficiency, and the slowing demand that we see in those weak new orders.
And the job losses and the low PMI scores.
Yeah.
That's the visible evidence of this part of the economy falling off. I think the biggest impact of this K-shape for a beginner listener is how it really affects inequality and just everyday life. If the virtual economy is creating all the wealth, but the real economy is where most of the jobs are, the average person feels like the economy is bad, even if the S&P 500 is hitting a new record.
That's spot on. The K-shape translates directly into wealth disparity and consumer confidence. People see their 401k benefiting from NVIDIA's spectacular returns, but they also see their neighbor losing their manufacturing job or their local Main Street business struggling with high borrowing costs.
It creates a real psychological disconnect.
A huge one. A disconnect between the abstract stock market and the lived economic reality. And that's precisely why investors need a portfolio strategy that explicitly addresses both of these diverging realities.
So we've established the split, and if the economy is fundamentally polarized like this, that passive buy-the-index strategy, it might not be enough anymore.
I don't think it is.
This polarization demands a highly disciplined dual approach. And this brings us to the core, actionable insight from all this data, the K-shaped portfolio strategy.
The K-shaped portfolio isn't some new, fancy trading method. It's a necessary strategic realignment. It's basically acknowledging the current market reality and building a hedge against volatility by investing systematically in both paths of the K.
Okay, let's get into the mechanics of that. The rising K, the growth side. We know this is AI and big tech, but what specific characteristics should our listener be looking for beyond just the famous names?
They need to be looking for companies with essential infrastructure roles. Think less about the flashy app layer and more about the fundamental picks and shovels of the AI gold rush.
So the companies that are building the actual railroad, not the companies hoping to run trains on it.
That's a great analogy. These are companies providing the essential chips, the networking components, the cloud services that have to expand, regardless of whether the broader manufacturing economy recovers next month. Their growth is structural, not cyclical.
And then the crucial counterbalance, the falling K, the defensive side. This acts as the insurance policy designed to protect your capital if the stagnation we've been talking about becomes a full-blown recession.
Defense means sectors that thrive, or at least remain stable, when the economy contracts. You have to focus on the traditional defensive sectors. Healthcare people get sick regardless of GDP.
Right.
Essential wings. Consumer staples, food, household goods, things you can't stop buying, and utilities, because we all need electricity and water. The key here is predictability of cash flow, even if it comes at the cost of high growth.
I have a challenging question for you then. If the K-shaped portfolio means combining pure growth like AI with deep defense like staples, aren't those two fundamentally contradictory ideas? Is the risk just that the gains from the rising K get canceled out by the slow and steady falling K and you end up with a mediocre return?
That's a brilliant point, and it's the primary concern you have to manage with this strategy.
Yeah.
The goal here isn't maximum growth at all costs. The goal is capital preservation and risk-adjusted return. In a polarized economy, a traditional S&P 500 index fund is already heavily weighted toward the rising K. So if that bubble in big tech bursts, that index fund takes a massive hit. The defense component is there specifically to cushion that fall. It ensures that when the market drops, you have dry powder, and more importantly, you have assets that are rising or at least holding steady, which allows you to stay invested without panic selling.
So for a beginner investor looking at their portfolio, what might a theoretical K-shaped allocation even look like? Is it 50-50?
Well, since the growth potential of AI is still so immense, our analysis suggests maintaining a slightly heavier weighting toward the growth side, but with really robust defensive buffers. A possible framework might be, say, 60% dedicated to the rising K, the big tech and AI infrastructure, and 40% dedicated to the falling K.
So that's the defense, the staples, utilities, and maybe some inflation hedges we'll talk about.
Exactly. This structure lets you participate in the rally while maintaining resilience against those real economy recession risks.
This leads us to a specific warning then, the reshoring theme. It's seductive, but it sounds like it could be a minefield for an undisciplined investor. You can't just blindly buy stocks because they announced they got a big government subsidy.
You absolutely cannot. We already established that the trade policy environment is volatile. Everyone loves the sound of the government carrot, but they often get burned by the whip of tariff risk.
And the whip can hurt more than the carrot helps.
100%.
Yeah.
A one-time government subsidy, no matter how large, can be completely wiped out over a couple of years if that company's operational costs spike because of unexpected tariffs on essential components. So investors have to perform some pretty intense due diligence.
So, what should be on the checklist for a beginner investor who's looking at companies promoting this domestic manufacturing theme?
The analysis highlights three non-negotiables. First, as we mentioned, the size of the subsidy is important, but it's only a starting point. Second, and this is critical, sensitivity to tariff policy changes. How dependent is this company on the Chinese supply chain?
Right.
Do they rely on specific rare earth minerals or complex sub-assemblies from Asia? If a tariff change could suddenly triple their raw material costs, that subsidy becomes totally irrelevant. The company has to demonstrate a viable, tariff-resistant supply chain plan.
That makes perfect sense. Their risk is directly tied to their global reliance.
It is. And third, financial stability. Building a huge new factory is a multi-year project. It requires enormous initial capital spending and a sustained cash burn until production finally scales up. In a high-interest rate environment like this one, only companies with truly robust balance sheets, minimal debt, and strong existing cash flow can actually sustain that kind of investment without collapsing under the weight of borrowing costs.
So you have to be wary of smaller, highly leveraged companies promising huge new factory builds.
Very wary.
Now, when you combine these negative factors, the falling employment and industrial stagnation from the falling K, with the rising costs driven by tariffs and persistent inflation, we run into the ugliest economic risk of all: stagflation. Stagnation plus inflation.
This is the absolute nightmare scenario for central bankers, and our data suggests the risk is elevated specifically because of trade policy. The tariffs themselves are inherently inflationary. They're just taxes on imports, which forces businesses to pay more, and they pass that cost on to consumers.
But at the same time, the recessionary signals, the job losses, the low PMI, the economy is also stalling.
Right. And this paralyzes the Federal Reserve.
Yeah.
They want to stimulate the economy with rate cuts to help manufacturing, but the tariff-driven costs prevent them from doing it because it would risk hyperinflation.
So it's a debilitating policy dilemma. Cutting rates to save jobs risks letting inflation run wild.
But maintaining high rates to fight inflation ensures the stagnation continues. This is why stagflation is so dangerous. It's a no-win scenario for the Fed.
So if the fear of stagflation intensifies, and it really seems poised to, what are the key inflation hedges a beginner investor should consider adding to that defensive 40% portion of their K portfolio?
You look at the classic assets designed to hold their value when the currency erodes. The main ones are gold and commodities, which represent real physical assets not tied to fiat currency. But for fixed income protection, investors should really look at TIPS, or Treasury inflation-protected securities.
For our listener who's maybe unfamiliar with TIPSs, what exactly are they, and how do they work to protect your capital during inflation?
So TIPS are essentially U.S. government bonds, which makes them extremely safe. But they have this unique feature. Their principal value, the amount you invest, is adjusted upward with the inflation rate, as measured by the CPI.
Ah, so if inflation spikes, the face value of your bond actually increases.
It does. It protects your purchasing power. Then, when the bond matures, you get paid the greater of the original face value or the new adjusted inflation index value. They are a dedicated government-backed tool for hedging against the very inflation risk that's being created by tariffs and spending.
Ultimately, whether a company survives these high costs from tariffs, interest rates, and inflation, it really boils down to one simple concept, doesn't it? Pricing power.
That's it. We saw it in the Magna example. Costs have to either be absorbed, which hurts profits, or passed on to the consumer. This ability to pass costs on without destroying demand is the ultimate test of a quality company.
It's the single most important characteristic of a defensive, high-quality company, and it's what gives a company that economic moat you hear about.
It is the moat. In times of high-cost uncertainty, companies with overwhelming market dominance and extremely strong brand power are the best positioned. They possess the pricing power to hike prices slightly, say, 3%, and their customers will just pay it.
Let's use a robust example to illustrate this moat concept. We named Coca-Cola and Apple earlier. Why are they so successful at passing on costs compared to, say, a generic competitor?
We'll take Apple. Their ecosystem is incredibly sticky. If the price of an iPhone component goes up because of a tariff, and Apple raises the retail price by $25, the consumer who is locked into the Apple ecosystem with their photos, their apps, their iMessage, is very unlikely to switch to a competitor to save $25. Their brand provides a kind of psychological lock-in.
Right. The switching cost is too high, even for a small price hike.
Exactly. Now contrast that with a generic commodity producer, say, a manufacturer of basic plastic components or generic steel. If they raise their price by even 1%, their customers will switch instantly to the next cheapest supplier. They have no moat, no pricing power, and so they are extremely vulnerable to cost spikes from stagflation or tariffs. Investing in this K-shaped environment means concentrating your capital in those companies with the biggest, deepest moats.
Okay, so we've established the economic split and how to structure a defensive portfolio. Now let's talk about the elephant in the room, risk. Despite these significant headwinds in the real economy, the stock market just keeps climbing. We ran the current environment through a historical checklist of 7 classic bubble warning signs, drawing data from recent filings and reports.
And the findings are, they're highly concerning. They demand a proactive risk strategy. 4 out of the 7 historical signals that characterize the 2000 dot-com and 2008 housing bubbles are already showing red, meaning they're active and working to inflate market risk right now.
Let's start with the one factor that's defying gravity monetary policy, because this is the single reason the party hasn't ended yet.
Monetary policy is flashing green. The bubble killer has been, temporarily deactivated. The key event was the October job shock, where the unemployment rate unexpectedly jumped to 4.4%.
And that bad news for the economy.
Was immediately interpreted by the market as great news for stocks because it entirely reversed tightening expectations. The market is now pricing in a 90%, maybe higher, chance that the Fed will begin cutting interest rates in late 2025 or early 2026. This expectation of cheap money returning is the strongest support for the bubble continuing.
Okay, now for the bad news. Let's look at what the sophisticated money is doing, starting with insider selling. That's a firm RED.
Insider selling is a crucial indicator. To track it, we look at 13F filings. For our beginner listener, can we just quickly clarify what a 13F filing is?
Absolutely. A 13F filing is a quarterly report required by the SEC for institutional investment managers who manage over $100 million. It basically forces them to disclose their equity holdings. It's a peek behind the curtain at what the smart money is actually buying and, more importantly, what they're selling.
Perfect. And the data from the 13F filings released on November 6th show that legendary hedge fund manager Michael Burry,
The big short guy.
the big short guy himself, dramatically increased his put options. Those are basically bets against price increases, and he's specifically targeting key AI names like NVIDIA and Palantir. This signals that the most sophisticated investors are actively positioning for a major market reversal.
When he's betting against the market, you have to pay attention. Okay, next. The dark side of euphoria. Fraud phenomena.
Another loud read. When investors get greedy, they stop asking tough questions, and accounting standards start to degrade. We saw this most recently with the bankruptcy of First Brands in the private credit market, that complex, non-bank lending world that's fueling a lot of this AI gold rush. The investigation exposed their use of fake EBITDA.
That sounds ominous. How does fake EBITDA work, and why is it a classic bubble symptom?
Well, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's supposed to measure a company's operational profitability. Fake EBITDA is just manipulation. Specifically, pulling forward future expected earnings into your current financials to make the company look healthier and more profitable than it really is, often so you can secure massive loans.
Wow.
This is a classic symptom of extreme risk-taking and greed. We saw it right before the 2000 crash with all the accounting scandals.
This sounds dangerously similar to the leverage issues of 2008, just shifted outside the traditional banking system.
It is. Now let's look at supplier finance rate again. This signals a dangerous circularity in the AI ecosystem.
Circular revenue. How do we define that in the context of big tech?
Think back to the dot-com bubble. You had telecom companies lending money to their own clients just so those clients could afford to buy the telecom company's fiber optic equipment. It looked like booming revenue on the books, but it was just money circling internally.
It wasn't real demand.
It wasn't real external demand. And today, we see criticism that OpenAI's massive contracts with key chip and cloud providers like NVIDIA, AMD, and Oracle might represent circular revenue. Money is recycling within the AI ecosystem to fund capacity build-out, but it's not yet being driven by genuine external paying customer demand from outside that tech circle. If that external demand doesn't materialize soon, this internal financing structure becomes unsustainable.
And finally, the general public getting in on the riskiest assets, individual participation.
A glaring RAD flag. We are seeing increasingly complex, high-risk products being packaged and passed down to the average retail investor. The single strongest warning sign here is Robinhood's plan to launch a private fund that would allow retail investors to buy into non-listed AI giants like OpenAI and Anthropic.
That sounds like the classic signal that a market peak is approaching when the general public becomes the last buyer of the most esoteric, complex risks.
It's the textbook definition.
Let's spend a moment on that Robinhood plan, because the data suggests this move generated more controversy among market analysts than almost anything else this year. Robinhood framed it as democratizing access to the highest growth private assets.
And it sounds good, but history teaches us that whenever high-risk, complex products get democratized, it often signals the top. This plan triggered an official SEC investigation on November 7th over potential violations of investor protection rules, and those concerns really highlight the structural risks of the current AI boom.
What were the SEC's specific regulatory concerns? I know Morningstar and other watchdogs shared them.
3 major points. First, liquidity risk. For a beginner investor, liquidity is just how fast you can sell an asset without losing a lot of value. These non-listed private assets are restricted. If the market crashes, you can't sell them instantly. You're financially trapped, maybe for years.
Okay, that's a huge risk.
Huge. Second, valuation opacity. How do you fairly value a private company like OpenAI that isn't traded on an open exchange? The valuation is often opaque, based on optimistic projections, and it's rarely transparent, which makes it really easy for bubbles to form. And third, operational experience. Robinhood is a brokerage platform. They have zero track record of running complex, illiquid private strategy funds.
This just mirrors the historical parallel perfectly. It's when Wall Street finds a way to polish up complex risk, guarantee the average person access to the next big thing, and sells it to the retail investor that we tend to see the market peak. This feels like the psychology of the 2000 dot-com frenzy being played out all over again.
It marks that transition from smart money buying the foundational technology to retail money being sold to concentrated risk. The people who got rich on the early AI growth are now finding ways to offload the most opaque, illiquid risks onto the general public. And that is the clearest signal of speculative excess.
This brings us to the core irrational market logic that's keeping the momentum going, despite the 4 red flags we just talked about. The market is ignoring fundamentals and focusing solely on liquidity.
The bad news is good news trap.
Explain that dynamic clearly for our listeners.
The core insight is this. The market is currently driven by one single expectation, that the Fed will cut rates. Therefore, any bad economic news, like a job shock, a decline in GDP, worsening manufacturing data, is interpreted as increasing the likelihood of the Fed cutting rates sooner.
So bad news about the economy is actually good news for stock prices because it promises more cheap money.
Exactly. Investors have to understand that the market is reacting exclusively to Fed signals, to liquidity expectations, and it's completely ignoring the actual bifurcated health of the underlying economy.
Now, given that we are seeing these systemic risks, the fake EBITDA in private credit, the circular financing, you warned earlier that the eventual crisis might be more 2008 style, not a simple 2000 style tech crash. But wait, isn't the Fed's balance sheet much smaller now? And aren't traditional banks much better capitalized? Are we truly facing systemic risk or just a deep sector correction in big tech?
That is a necessary pushback, and you're right, traditional banks are generally better capitalized today than they were in 2007. However, the systemic risk has migrated. It has shifted almost entirely into the unregulated shadow banking system, the private credit market. This market funds leveraged companies using less transparent rules, and it is now enormous.
So the problem isn't the banks anymore.
This systemic issue isn't the banks.
Yeah.
It's the interconnected, highly leveraged non-bank world that's funding the current AI boom. If liquidity freezes there, which that fake EBITDA case suggests is possible, it could indeed lead to a 2008-style liquidity freeze across multiple markets, not just a simple tech stock reset.
Which makes having an exit strategy essential. Now is the time to prepare, not when the music stops.
Absolutely paramount. Because of the leverage and complexity, waiting to sell might mean you can't sell at all, or only at distressed prices. Now is the time to take some profits, increase your cash holdings. Remember that defensive 40% in the K-shaped portfolio, and most importantly for a beginner investor, set defined sell limits or stop-loss lines.
Can you define a stop-loss order for us?
A stop-loss is a basic but critical risk management tool. It's an instruction you give your brokerage to automatically sell a security if it drops to a specific price. For example, if you bought a stock at $100, you might set a stop-loss at $90. If the market suddenly crashes, you are automatically forced out of the position, limiting your loss to 10%.
And it removes the devastating need to make an emotional panic decision in a volatile market.
Exactly. It takes the emotion right out of it.
So the advice isn't total divestment, but refinement. If the momentum continues, how do investors participate smartly without getting crushed when the bubble deflates?
You have to ruthlessly weed out the weeds, the complex products like those new private funds, the highly leveraged companies, and any AI stock that's trading purely on hype with zero path to profit. You must concentrate your capital on the core AI infrastructure leaders, the few quality big tech companies with strong cash flows and real profitability that have the best chance of surviving the inevitable burst.
The essential supplier.
They are the essential suppliers regardless of the coming recession.
So we have to be ready to act instantly. The analysis identifies two clear signals, two triggers for 2026 that will tell us when the underlying market logic finally shifts and the party is truly over.
The first trigger is the Federal Reserve. If those anticipated rate cuts do not materialize in 2026, maybe because services inflation or high tariffs persist, or if some new crisis forces the Fed to reverse course and resume tightening, the liquidity-driven rally ends immediately. The market is built on the hope of cheap money. You remove that hope, the whole structure collapses.
And the second trigger focuses on the fundamentals of the rising K itself.
That's big tech earnings. If the AI profitability dilemma, where the colossal cost of building AI infrastructure is suppressing profits, if that continues into 2026 and the crucial revenue growth simultaneously slows down, the market will lose its primary narrative. Investors should enjoy this current momentum market, but they have to be ready to act instantly when those two triggers fire. They are the market's two clear warning lights.
We've covered the macro risks and the strategy. Now we need to pivot to the most important factor in your long-term success, your own behavior. Because even the most brilliantly designed portfolio will fail if you can't manage your psychology when the market moves against you.
This is a massive emotional hurdle right now. So many investors, particularly those who sold during the volatility of 2022, are sitting on substantial cash. They feel the market is too high to buy in, but they're also being tortured by the fear of missing out on the rally. This is a paralyzing emotional struggle.
This feeling isn't new, is it? It's a classic investor paralysis. I know people who are feeling this right now. They're frozen.
Exactly. And we see this historically. Even sophisticated investors at institutions like JP Morgan were often paralyzed, holding cash for years after major bull markets had already started, because they were convinced that this time the market had gone too high too fast. And the result is years of missed compounding returns.
That fear of missing out, or FOMO, coupled with the certainty that you know when the next dip will happen, often leads to the biggest mistake of all: panic selling.
Panic selling must be avoided at all costs. When you sell stocks for cash in a moment of fear, you interrupt the powerful, silent effect of compounding returns. But worse, you create a new, impossible decision. You are now forced to judge if you're smart enough to perfectly time the re-entry point.
And the data consistently proves that virtually no one can do that successfully.
No one. So if you sell high, you often miss the early stages of the recovery, and then you're faced with the dilemma of buying back in higher than where you sold, which our ego finds almost impossible to accept.
That's the ego trap. You turn two decisions, when to sell and when to buy back, into one emotional mistake.
The data overwhelmingly shows that market crises are historically times of massive opportunity, not times to liquidate quality assets. The investor's job is to stay invested and allow compounding to work its magic.
So for those listeners who've been holding substantial cash, maybe admitting that waiting for the perfect correction was a mistake is the first step toward recovery. What is the practical, non-emotional solution for getting that capital back into the game now?
The analysis strongly recommends dollar cost averaging, or DCA. This strategy removes emotion entirely. It's the simple, powerful act of committing to investing a fixed amount of cash at regular intervals, say, every 15th of the month, regardless of the current market price.
It sounds simple, but how do we apply this specifically to someone sitting on a large pile of cash? You're not saying they should just jump back in with 50% tomorrow, hoping for a quick rebound.
Absolutely not. Do not buy back in 100% at once, and critically, do not wait for the correction, because too many investors are already waiting on the sidelines for that same dip, which means that dip may be shallow or never even arrive. The specific action plan recommended is a disciplined, multi-month approach.
Okay.
Rebuild your position by buying approximately 112th, or about 8 to 10%, of your cash pile every single month over a 12-month period.
So by spreading the investment out over a whole year, you automatically remove the need to guess the market bottom. And you guarantee that you buy more shares when prices dip and fewer shares when prices rise.
It's mechanical and non-emotional. It eliminates that crippling regret of choosing the wrong day to invest, and it ensures your capital starts benefiting from the power of compounding immediately.
Mm.
DCA is the highest conviction strategy for moving cash from the sidelines back into quality assets without risking a devastating one-time investment mistake.
Beyond DCA, we need to address the common behavioral biases that just relentlessly harm individual investors, especially in volatile periods like this K-shaped economy. Let's start with the one that affects us all, the ego. Why is it so hard not to personalize our investments?
Investors often view stock movements emotionally, seeing the market as this adversarial force against them. When prices fall, it feels like a personal failure, and they fall into this cognitive dissonance. They start believing the market is fundamentally wrong rather than questioning their own initial thesis.
So what's the solution?
You have to treat investing as a cold, calculating analysis of business fundamentals, not a reflection of your own intelligence. When prices fall, instead of feeling despair, you should be asking, does this price drop change the company's long-term earnings prospects? If the answer is no, it's just an opportunity.
And what about the subtle but important difference between stubbornness and conviction?
Stubbornness is believing you are smarter than the market and refusing to acknowledge or act on contradicting data simply because it undermines your initial decision. You have to be flexible. Conviction, on the other hand, means anchoring your investment decision to sound, observable fundamentals, like the proven cash flow of a defensive stock or the structural growth of an AI leader. The goal isn't to win an argument against the market. The goal is to invest wisely and allow time to compound your returns.
Which brings us all the way back to the myth of the perfect entry point.
Long-term investors must eliminate the obsession with finding the absolute lowest price. You will never, ever perfectly time the market. The vast majority of investor gains are made not by timing, but by being consistently invested in high-quality companies. DCA into those quality companies negates the psychological need for perfection and is the far more reliable path to building long-term wealth.
We often use the term smart money to describe large hedge funds, but the analysis reframes who the real smart money truly is in this environment.
Often, the real smart money is the patient individual investor who has a decades-long time horizon. Institutional investors often suffer from debilitating short-term thinking. They're benchmarked monthly and quarterly, facing immense peer pressure to outperform right now.
So that forces them to try and time the market.
It forces them into short-term trading of long-term growth stories like Nvidia or Palantir, simply because they fear career risk if they underperform their peers for a single quarter.
So institutional investors are inherently incentivized to trade the volatility, while the individual investor has the inherent structural advantage of patience.
That is the crucial takeaway for our beginner listener. Your time horizon is your most valuable asset. The individual investor who has the patience to analyze a business for its long-term potential and ignore the daily noise and institutional short-term pressure is the one who ultimately captures the greatest compounding profits. For new investors starting after 2023, be ready for long, painful periods of self-doubt where the market looks sideways or even dips for years. But maintaining that conviction and resolve is what separates the successful from the emotional trader. Remember, the greatest profits are always generated by investing at the lows, not by trying to trade at the highs.
This has been an incredibly detailed and, I think, critical look at the current investment landscape. Let's quickly summarize the core lessons that should guide your investment discipline moving forward. First, the K-shaped economic reality is here, and it demands a dual portfolio approach that rigorously balances aggressive AI growth with defensive, recession-resistant stability. Second, in this volatile environment, pricing power is the key survival trait. Stick with those quality companies that possess an unshakable moat and can pass rising costs to the consumer. Third, bubble warning signs are flashing red, making risk management, specifically establishing an exit strategy, defining stop-loss lines, and increasing cash reserves, absolutely essential right now. And fourth, behavior matters far more than timing. Use dollar-cost averaging to address your cash dilemma and maintain long-term conviction, ignoring the daily distracting noise.
And here is a final provocative thought for you to consider. Given the current market is almost entirely powered by liquidity expectations and the hope for interest rate cuts, how will you differentiate between the handful of companies truly building the vital, foundational AI infrastructure, the necessary utilities of tomorrow, and those simply benefiting from the short-term hype to ensure your portfolio survives when the inevitable return to fundamental market logic finally occurs?
That is a perfect and powerful question to close on. Thank you for joining us for this deep dive into the U.S. markets. Don't forget to subscribe and hit that like button.